Bismillah ar-Rahman ar-Rahim. My dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. This is the last chapter with regard to financial institutions accounting, the part of bank accounting. Sorry. All this chapter deals with how to evaluate performance of commercial banks. So what are the techniques of assessing commercial banks' performance? To deal with this matter, we want to know what is meant by evaluation and what precede evaluation, either with regard to control or planning. And this means that I have to consider the meaning of each. Evaluation usually means assuring that the designed plans and policies are achieved, are met, are realized for reaching the planned objectives or goals. And this helps in improving performance and continuous improving performance, as well as achieving higher levels of efficiency. Performance evaluation or performance assessment as a post-planning stage comes after two important phases or stages: control and follow-up. The first, that's control, concerned with making sure that fulfilling of actualities is as planned for. So actual performance is equal to planned performance. That is the budget. The second phase or the second stage, that's follow-up, helps in activating control as a first stage and may lead to preventive control. Preventive control means that mistakes will not take place, or helping in avoiding unfavorable deviations, unfavorable variances, or taking the corrective action as soon as these deviations take place or occur. Techniques of banks' performance evaluation. First, the use of percentages and rates to evaluate the performance. To evaluate the performance. Is there a difference between rates and percentages? Yes. Because rates means comparing two items without multiplying by 100. So it will be 1 to 2, 3 to 4, and so on. But percentage, the same as rates, but with multiplying by 100, and it is a percentage. To explain this, there are many ratios and rates that can be used in performing banks' performance. To evaluate banks' performance. And we refer through the following to the most important of these ratios and rates that are closely related to banking activities, both in terms of local currency and foreign currency. So you have to know from now on up that performance evaluation should be twice. Once using local currencies, the other uses foreign currencies, regarding liquidity, profitability, capital adequacy, and funds investments, as well as growth rates in commercial banks. In general, liquidity, when dealing with it, we deal with it as a third technique in the entities rather than banks. Why? Because we have what is called current ratios or rates, quick current ratios or rates, then liquidity rates or ratios. But as banks deal with money, so the three are taken together in one, that is liquidity. And getting liquidity means comparing current assets by current liabilities, dividing current assets by current liabilities. We get the rate needed. With regard to profitability, as we will see, it means that we divide profits, the realized profits in a certain year, by some other factors. For example, I need profitability of sales. I have to divide profits by sales. I need profitability of invested fund. I have to divide profits by invested fund. I'm in need of profitability of fixed assets. I have to divide profits by fixed assets. All these relations should be multiplied by 100 to get it as a ratio. Capital adequacy, it means we have to consider the capital invested with other funds invested. That's why we say capital adequacy and funds investment. Then growth rates in commercial banks means any item it was and it became, then we have to divide the second year by the first year. So suppose I'm dealing with for example capital in the first year was 100. In the second year it became 110. So dividing 110 by 100 gives you the growth rate. Suppose I'm dealing with fixed assets. Fixed assets equal in the first year, for example, 200,000. In the second year, 300,000. So divide 300,000 of the second year by the 200,000 of the first year means 150%. Okay? But in this 4, it is a percentage. But if I want gross rate, I will say 300,000 divided 200,000, but without multiplying by 100. So it will equal 3 to 2. 300,000 divided 200,000 means 3 to 2. This is a growth rate. It means 150%, yes, if it is a ratio, not a rate. By this, I'm explaining again the difference between rate and ratio. So, you have to open the book now with me to find the answer of the 4 examples regarding liquidity, profitability, capital adequacy, and other ratios and rates. This means that you have to look, as the slide shows you, liquidity rate in local and foreign currency in pages 259, 261, profitability ratios at 261, capital adequacy ratios at page 261, 262, then other ratios and rates at page 263 and 264. All are regarding ratios and rates. But there are other techniques for performance evaluation we will see after finishing this explanation. And second, it will be the use of horizontal and vertical analysis to assess the performance of commercial banks. So instead of rates and ratios, I will use the statements itself to make horizontal analysis and vertical analysis for evaluating the performance of the commercial banks. And it will be in page 264, 267. At the end of the second type of evaluation techniques, there are two activities you have to look for. The two activities are in page 271 and 272. This is activity number 1. Activity number 2. But activity number 1 in page 267 to 68. These two activities may be used instead of the midterm exam from my own point of view. But we have to fulfill these two activities. The first in page 267, 268, and the second one 271 and it's back 272. And you may give these two activities to the library you purchase the book from, or to the demonstrator if you find him in the college, or if you will go to the college before the exam. I prefer to give it to the demonstrator of this subject. That is Dr. Laura, I think. Okay? It may be used for the classwork and midterm exam. Otherwise, if there is any instructions regarding our country, our university, our college, it will be used as they give these instructions. The third kind of evaluation techniques is trend analysis and regression analysis. Look page 273 to 5. Now, 5. Solving example 1. Please open the book at page 259, 260 and 261 to solve this example together to see how to solve it. Through this first example, he told you that the following data were available in relation to current assets and current liabilities, and this means that he wants you to calculate the liquidity rates in foreign currency and in local currency, because he is giving you the two items needed. I mean the current liabilities and the current assets. The following data were available in relation to current assets and current liabilities, as well as other items regarding one of the commercial banks operating in Egypt as at December 31st, 2018, and you are required to identify the liquidity of both local currency and foreign currency rate. Comment is a must, so it is not a matter of solving it only, the numerator and denominator and the result. No, you have to comment. So comment is a must. Values are in 1,000 Egyptian pounds and foreign currency denominated in United States dollars on the date, and referred to by the symbol FCC. FCC means foreign currency. So abbreviation of foreign currency, FCC. Treasury bills, it is a current asset. 27,000. As he didn't say FCC, so it is not foreign currency. So it is local currency. And this is the Egyptian treasury. So treasury bills of Egypt, it will be in local currency. Undistributed profits. From my own point of view, it is one of the liabilities. But in commercial banks, they neglect it. Balance of gold, 8,000. And balance of gold is a current asset, but without telling you, we have to consider it with the current rate or the liquidity rate of foreign currency. So gold is taken as current asset in foreign currency. Issued letters of guarantee. Either letters of guarantee or we call it letters of credit is one of our current liabilities because it is less than 1 year. If it is more than 1 year, it means that it is long-term liabilities. I will not consider. But the letters of guarantee or credit is for less than 1 year, so it is current liabilities. Fixed assets, I think we haven't to consider because it is fixed assets, not current assets. Dues on the bank to other banks, as dues on the bank to other banks, so this is a liability. But I have also dues for the bank on other banks, so it is a current asset. So the first one, dues on the bank, current liabilities, but dues for the bank is current asset. Consider a very important point here. The dues on the bank is 500,000. Dues for the bank is 150,000. I have to take the difference and consider it according to the largest, the biggest. So as the biggest is 500,000 current liability and the smallest 150 current asset, so there is net current liability of 350. 500,000 current liability in local currency minus 150 means 350. Why we took it, consider it a liability? Because liability is more than the current asset. You will find the opposite regarding the foreign currency. The foreign currency, the dues on the bank 300,000. The dues for the bank 340. So the current assets in foreign currency is more than the current liability. So the difference is net current asset of 40,000. I think it is clear now. Customer deposits means current liabilities. Discounted commercial bills, dues for the bank. As it is dues for the bank, so it is a current asset. Governmental bonds, it is an asset, current asset. Excess of cash reserve with the central bank. In general, cash is a current asset. So excess of cash reserve with the central bank, I will consider the reserve of the central bank, but the excess should be added to the cash of the bank. Accrued credit commission. Accrued credit commission is credit commission for the bank I didn't receive yet. So I have to consider it as current assets, but commercial bank for sorrow neglected. So now we have 3 items to be neglected. The second item in the page, that is undistributed profits, the fixed assets, and the accrued credit commissions. Then I have checks and money orders payable. As checks payable and money order payable, so this is a current liability. Cash on hand, it is a current asset. Remittances and the coupons receivable, just as accounts receivable, as notes receivable, so current asset. US development bonds, it is current asset, but in foreign currency, that's why it is in dollar. By this way, I analyze with you all the items before solving the example. Note the following. With respect to the letters of guarantee or letters of credit issued in local currency, include the percentage of 25% of it, 15% of it, 5% of it, of these letters, as a cash covered and elementary letters, not permanent, as well as guaranteed letters from first degree foreign bank respectively. And as it is guaranteed letters from first degree foreign banks, if you will go back to the first chapter with regard to Basel 1, 2 and 3, you will know what is meant by guaranteed letters from first degree foreign banks. These are 25%, 15%, 5% must be excluded from the letters of guarantee, the local letters of guarantee, as he said. While the corresponding percentages are 18%, 20%, 21% and 11% respectively with respect to letters of guarantee issued in foreign currency. So regarding local currency, I have to deduct, exclude 25%, 15%, 5%, this means 45% of local letters of guarantee should be taken out and will not be considered while I'm taking the current liabilities into consideration. The corresponding percentages regarding foreign currency are 18, 21, and 11. This means 39, 45, I think 45, 18, 21, so equal 39, 39, it equal 50%, plus 11, 50%. Number 2, as a notice, for the discounted commercial bills, its average maturity is 80 days. This means that if I am calculating the provision of discounted commercial bills, I have to consider 80 days, and it is a short-term period. Preparation for solution. The items of fixed assets, the accrued credit commissions, and the undistributed profits are related to the liquidity rates calculation, either for local or foreign currency, as I told you at first. Out of the letters of guarantee, we have to exclude the mentioned ratios with respect to the cash cover, elementary letters, and security guaranteed by mentioned condition. Therefore, the addition of the issued letters of guarantee to the numerator relationship is as follows. We will go back again for this slide, but the items and the values will be taken from the example, so the book should be in your hand. The items of fixed asset, the second, the accrued credit commissions and the undistributed profits are unrelated to the liquidity rates calculation, either for or foreign currency, from the commercial bank point of view. That's why we have to neglect. Out of the issued letters of guarantee, we have to exclude the mentioned ratios with respect to the cash cover, elementary letters, and security guaranteed by the mentioned condition, but regarding local, then foreign currency, this was 45%, I think. The second was 50%. Therefore, the addition of the issued letters of guarantee to the numerator relationship, I mean these items to be taken as current liabilities or current assets, should be as 4 letters of credit in local currency. The value is 430,000 Egyptian pound. We have to exclude 40%, 45%. 45% because he mentioned that the percentages were 25, 15, and 5 in page 259. So the total is 45%. So 1 minus 45% means 55%. Times 430 gives 236,500. This is the value that we will consider while preparing the rates needed. For letters of credit in foreign currency, it was 290,000. If you look again in page 259, you find that this is 290. That is the 1, 2, 3, the fourth item. Issued letters of guarantee. 430 we finished it in local currency, 290 in foreign currency. 290, and the percentage to be excluded in the end of that page, 1, 2, 3, the fourth line from bottom, 18%, 21%, and 11%, it is 50%. So 290 times 1 minus 50%, this means 290 times 50% gives 145,000. And now we can determine the intended sum relating to each of the current assets and current liabilities. Why? To divide current assets by current liabilities and get the rate, one for local currency and the second for foreign currency. As follows: summation of local current assets equal treasury bills, discounted commercial bills dues for the bank, governmental bonds, cash reserve with the central bank, cash on hand, remittances and coupons receivable, and these together 27,000 plus 21,000 plus 37,000 plus 180,000 plus 105,000 plus 80,000 equal 450,000. So the local current asset that will be in the numerator of the liquidity rate in local currency will be 450. What about the denominator? Summation of local current liabilities equal issued letters of guarantee, dues on the bank to other banks minus dues for the bank from other banks. And I explained to you while we were reading the exam. Customer deposits, the deposits of customers are current liabilities. Checks and money orders payable liability. So 236,500 plus the difference between 500,000 and 150 dues on and dues for the bank, plus 812,000 plus 739,000, it gives 2,137,500, and this is the denominator of the relation of local liquidity. That's why we have to divide 450 by 2,137,500, as we will see, but in the slide next to this one. Now, what about the summation of foreign currencies current assets? Balance of gold, I told you, will be considered in the current assets in local in foreign currency with foreign currency. Dues for the bank on other banks minus dues on the bank to other banks. Why you considered it here as current assets while the local one we consider liability? Because in the local one the dues on the bank were more than the dues for the bank. So the liabilities more than assets, we took the net value as current liability. But here, the dues for the bank in foreign currency is more than the dues on the bank. So the net is dues for the bank. So we considered it as current assets. Cash reserve with the central bank. Yes. Undistributed profits. Okay. Cash on hand. Right. US development bonds equal 8,000 plus 340 minus 300 plus 150 plus 67,000 plus 80,000 plus 17,000. It gives 362,000. This is the current assets in foreign currency. Excuse me, before considering summation of foreign currency in current liabilities, there is a mistake in calculating the foreign currency's current assets. Where is this mistake? Look in the fourth line, undistributed profits. I told you while explaining that undistributed profits will not be considered because commercial banks neglect it in calculating these ratios. But the one to be taken into account, it is remittances and the coupons receivable. Remittances and the coupons receivable. That is 67,000 in foreign currency. So the calculation is correct. But the reason is that the 67,000 was the same as undistributed profits. This is the mistake here. Now, summation of foreign currencies current liabilities, issued letters of guarantee that we prepared it in the previous in the one previous slide, customer deposits, checks and money order payable, the total 145,000, 912,000, 391,000, the total 1,448,000. That's why if dividing 362,000 current assets in foreign currency by 1,448,000 current liabilities in foreign currency, I will get the liquidity rate in foreign currency. Liquidity rate in local currency, 450,000 divided 2,137,500 gives 1 to 4.75. and with the ratio of 21.053% approximately, if we want to calculate it as a percentage, which achieves the Central Bank of Egypt condition with respect to the cash reserve, the rate of 1 to 5 at least. Liquidity rate in foreign currency, 362,000, that is current assets in foreign currency, divided 1,448,000 current liabilities in foreign currency. It gives 1 to 4 or 25% if you want to calculate it as a percentage, which corresponds to the cash reserve ratio set by the Central Bank of, the profitability of revenues means that the 9,450 will be divided by the revenue. Profitability of assets, so the 9,450 should be divided by gross assets. Profitability of equity, so the 9,450 should be divided by equity. The profitability of deposits, so the 9,450 should be divided by the customer's deposits. So the 9,450 divided by 95,555, that is revenues, times 100 gives 9.89% approximately. This is profitability of revenues. What about profitability of assets? When dividing 9,450 by 229,215 and multiplying by 100, it gives 4.196% approximately. That is the assets profitability. Then the profitability of equity, by the same way, I got 52.823% approximately. Profitability of deposits, it is 4.98% approximately. By this, we finished the second example regarding profitability, and I think it is very simple, very easy to solve it, but consider that always we are dividing or we are using the before tax profit, the before tax income. I mean the operating income. So if in the exam I give you the operating income directly, but if I gave you the net income, the net profit, you have to calculate the before tax income before getting these ratios. Don't forget these. Now, solving example 3, we can calculate the required ratios after determining the equity, which equal 5,720 plus 1,235 plus 185 gives 7,140. What does it mean? So we have to open our book and to read the example together. Capital adequacy ratios, the example in page 262.
It is in page
263. The capital adequacy ratios
263.
using the following data.
It needs
from one of the
some
commercial banks records.
ratios
of the
rates.
first year,
We have to read the requirement for
physical
the
year.
instruction.
Example
17,
4, use the
18,
following available
values
data
are in
to
thousands
determine
pounds.
the percentage of each
He gave
of
me paid up
loans and
capital,
investment in securities
gross
to
deposits,
for the
gross
assets
2018,
reserves
in addition
to the
return
ratio of
and
physical
undistributed
collateral
profits,
loans
gross
loans
and
the
the
proportion of loans
including
to loans guarantees as well as determining
without
the available
collateral
without
rates.
guarantee. So
Then
he is
gross
in need
financial
of
investment.
3 ratios.
If we
Then
look to
some of the
all
gross rates. These items.
The 3 ratios are
The ratio
we find
of
that
investment in securities
we
to
are in need
deposits. These are the
determining
numerator and
the
denominator.
adequacy,
The proportion
the adequacy
of or the
capital
percentage of
or the
loans
capital
to
adequacy
collateral
ratio
loans
regarding
with
gross
collateral to
deposits,
gross loans. So
gross
the loans
assets,
with guarantee to gross loans.
gross
Then
loans,
the proportion all
gross
the
financial
percentage of
investments.
loans to long
What
guarantees.
is the numerator?
To
The
loan
numerator
guarantees.
is
These are the
equity.
3%.
What about
then
equity?
He told
Equity
me
means
all what
build
can
up
you
capital
calculate from
plus
the
reserve
gross
plus
rates
return
calculated
and
and undistributed profits.
Okay.
That's why in the solution
Now,
here in our slide we
the
began
proportion
by
of loans to deposits,
adding
each of the bid-up
figure
capital
representing loans,
and
these
the
are
undistributed
this
profits
is the
plus
figure
the reserves
representing
to get deposits,
and the percentage
700
is 7,140
to be the numerator
investment
of
in securities
the,
to deposits, investments
other
in securities
items in the example
for which we want the equity ratio
that
to be divided by
50,
number one by
equity ratio to gross
4,980
assets,
equity ratio to gross loans,
as given
equity
in the
ratio
example.
to free
It
of
gives,
physical guarantee
uh,
loans,
excuse me,
equity
sorry.
ratio to gross financial investments
3,500
in
to
all
118
these
ratios.
if the
Deducting
numerator is
the
4,980,
that is equity.
that is the
But
without
the
collateral or
numerator
guarantee
was 120,
divided by the 35,218
that is the gross
loans gives
ratio.
85.86%.
Then we divided by
42,000,
then
dividing 30,218 by 50,000, that is loans
then
to
the
loan
equity
guarantee
rate to
a
gross
proportion of
financial
loans
investments,
to loan
that is
guarantee, it gives you
36,210 as given in the example.
433.
I got the equity ratio to gross
70.437%,
deposits,
that is divided by 81
Now,
419. We got
these,
the ratios,
ratios,
as you see
he
in
wants
this
the
example.
different
Now, rates. We want to look to
what?
example number
Of
4.
gross deposits,
And
of
regarding
gross
example
loans,
number
of gross
4,
investments, of gross revenue, of gross equity, of market value of loans guarantee, of earning per share, all these items I have its value in 2017
and in 2018. I have to get the value of the second year divided the value
year for each item.
alone. So all the following growth rates are calculated through dividing the value of the item in the second year by its value in the first year. Loan growth rate, growth rate of investment, deposit growth rate, revenue growth rate, equity growth rate, earnings per share growth rate, all I use the second year value by the first year value to get the result as you see in this rate. Before explaining trend analysis in page 73, I want you to remember that the activity in page 267 and its back 268, as well as the activity in page 271 and its back 272, may be used unless there is any other instruction from the country, from the university, from the college, from the Department of Accounting. It may be used instead of the classwork degrees or for the midterm exam, and these two activities should be prepared, and you have to give it to your demonstrator, assistant lecturer, Laura, just when you go back to the college or before the exam, whichever the earlier. Regarding the trend analysis, if you look with me in page 273, in the third paragraph, he said, for illustration, suppose the availability of the following data with respect to both deposits and loans, as well as bad debts and revenue of providing bank services through 8 years time series, starting from 2011, and you are required to prepare the trend analysis, and this is our topic now, for each of loans, bad debts, and revenues, these 3 items only. Then, using the deposit values during the period to predict the value of deposits in 2020, where it is expected that the interest rate on deposit will be 9.1%, and that the interest rate on deposits is the only influential factor, the only affecting factor. The table we have the column of years, then loans value, deposits value, bad debts value, and these are the 3 items that we will prepare the trend analysis for them. Then the other two columns will be used to explain the regression analysis, the last item of this lecture we will see afterwards. So you are in need of the first three columns. Look to the slide, please. Now, if you look, trend analysis for each of loans, bad debts, and revenue, considering the year 2008 as a base year. So, beginning by the year 2008, then 2009, 2010, 2011, 12, 13, 14, and 15, I have the value of loans in the first column regarding the columns of loan. I have the value of bad debts in the first column of the three columns of bad debts. The value of revenue in the first column of the three columns of revenues. Now, begin with me in loans. The value is 710. And I am considering the year 2008 is the first year. So there is no year before it to compare. So in this year, 710, there is nothing to compare with. So the variance is 0 and the percentage is 0. Now consider the 710. It became in the second year 690. So decreased by 20. The 710 became 811. So increased by 101. It became 2850. So it increased by 140. Then increased by 35. Increased by 100. Increased by 174. Increased by 189. All these are variances, either by minus or by positive. If dividing the variance by the 710, that is the base, I will get the percentage. So negative 20 divided 710. 101 divided 710. 140 divided 710. 35 divided 710, and so on. I get this percentage. This is called trend analysis. Bad debts. It was 4.2 and became 3.5. So there is a decrease of 0.7. The 4.2 became 4. So the decrease is 0.2. The 4.2 became 4.3. So there is an increase of 0.1, and so on. If dividing each of these variances by 4.2, I will get this percentage. The same as revenues, to say that 89, it became 94, increase of 5. 89, it became 99, so increase of 10. 89, it became 108, increase of 19, and so on. Dividing each variance by the 89, I get the percentage of the variance, and this is called the trend analysis. Now, using regression analysis method to predict the value of deposits, it will not be difficult for you, because through managerial accounting, if you remember in first term, we were separating variable and fixed cost and mixed cost using two main methods. If you remember, high-low method and regression analysis method. This is regression analysis method. According to the available data, the best technique is the sample linear regression technique, because we have one only dependable variable and one only undependable variable. That's why the linear regression technique, based on the basis of the straight line equation y equal a plus bx, it requires the representation and preparation of the following table to determine the value of each of x squared and the summation of xy. I mean, I have to determine x and get x squared and its summation, x, y, multiplying them to get xy and their totals, to as represented in the following slide. The example in the page 274, 200. We got the deposits from the example or illustration in page 273. That is the column before the last one. Regarding the deposits, then the third column, deposit value, we got it, and we got
the last column of deposit interest percentage. So the deposits is one of my variables, that is the dependable variable, and the percentage is the independent variable. You know why? Because when the interest rate increase, the deposits increase. When the interest rate or percentage decrease, the deposits decrease. That's why deposits is the dependable variable and the interest percentage is the independent variable. So now, the total of the interest equal 77.28. Its average is 9.66. So I have to deduct 9.66 from 9.03, 9.25, 9.75, 10, 9, 9.5, 10.25, 10.5 to get the X. Then the total of the deposits is 8680. Divided by their numbers, the average is 1085. If 1085 will be deducted from 950, 980, 1100, and so on, I will get the deviation or the Y, that is the deposits minus its average. To get these figures, I have to be sure that the total of X is 0, as I explained to you before, and the summation of Y is 0, to be sure that all my calculations are okay. Then, if you multiply X by itself, I will get X squared. If you multiply X by Y, I will get XY. Why I did this? Because I am in need of summation of X squared to be the denominator, and the summation of XY to be the numerator, to get at end the B. Then I will use the two averages of deposits and interest rate to get A. Then I will use the equation Y equal A plus BX to get the required. B equal summation XY 389.7 divided summation X squared 2.2036. It gives 176.847 approximately. As Y equal A plus BX, so 1085 the average of Y equal A, it should be small a, it doesn't matter, plus 176.847, just we got it as B, multiplied by 9.66, that is the average of X. So the 1085 equal A plus 1708.342. So A equal 623.342. The expected value of the deposits for the year 2017 or 2020, as he told me in the example, can be calculated as follows: Y equal A plus BX. So this is A and this is B, multiplied by the given X of the following year, that is 9.1, to get 985.966. This is the expected deposit of the year. Now I say thank you very much. Please don't be afraid of the exam. The exam will be attainable for all of you, conditional that you studied well what we explained. Then the exam will be away from any difficulties, but you have to study well all what we explained. Hoping you good luck, and I hope to see you in the class before the exam. ولكن لما ربنا يفك الغمة اللي احنا فيها دي، اللهم اصرف عنا الوباء والبلاء والأسقام جميعها وعن البشرية جمعاء. وشكرا جزيلا ونراكم دائما على خير، والسلام عليكم ورحمة الله وبركاته.